What's up, everybody? Crypto Noah back with another video. This is video number 3 of our passive income war series. I did one on yield farming versus bonds, and I did one on yield farming versus real estate. In this video, we're going to be comparing yield farming with dividend paying stocks. Okay, so in this video, I'm going to explain what yield farming is. I'm explaining what a dividend stock is, how it works, all the details around it, and I'm comparing and contrasting all of the major points. So before we get into it, I do have to say none of this is financial advice. These are my own perspectives, research, and opinions, and they should be treated as such. All right, so without further ado, let's jump straight into the content. Starting off with what is yield farming and what are dividend paying stocks. So there's 4 ways to get a yield in crypto. You have staking on a blockchain's validator network, such as the ETH 2.0 beacon chain, the staking contract. You can get a yield for securing the network. You can loan out your funds on borrowing and lending platforms, get paid to loan out your funds. You can get a yield from staking your funds on insurance platforms such as Nexus Mutual, and you get paid passively to facilitate insurance premiums. And the most profitable way, the way we always talk about on this channel, is staking your funds on decentralized exchanges. So you get paid anytime there's a swap that happens in the pool that you deposit your funds into. So for example, if you want to get paid in ETH and USDC, you can deposit your ETH and your USDC into a pool on Uniswap or Aerodrome or Velodrome or Trader Joe or one of the many dexes that we talk about, and you get paid anytime someone swaps from ETH to USDC or USDC to ETH. Now, what are dividend paying stocks? So you already know what stock is. It's a percentage of a company. You know, when a company goes public, they'll split up pieces of it. Let's call it 20%. And split it into multiple pieces so that you can own a piece of it. It's essentially a way for a company to raise money so they can use the funds to grow the business and increase what's called earnings per share, which is basically just catering to the shareholders. So there's 2 main ways to invest in dividend paying stocks. So you have funds such as index funds or ETFs or exchange traded funds, and they hold dividend paying stocks, or by purchasing individual dividend stocks. So dividend ETFs or index funds offer investors access to a selection of dividend stocks within a single investment. So for example, when you buy the S&P 500, you're holding a mixture of 500 different stocks through one share, basically. Or I can choose one of those 500 stocks on the S&P and just hold that one. Same thing with the dividend paying stocks. So that means with just one transaction, you can own a portfolio of dividend stocks. The fund will then pay you dividends on a regular basis, which you can take as income or you can reinvest. And dividend funds offer the benefit of instant diversification. So if one stock held by the fund cuts or suspends its dividend, you can still rely on income from the others. All right, so I just recorded the whole video and realized I wasn't recording. So here we are 2 days later, re-recording. I'm gonna make it better. So let's get back into it. All right, guys, so I have this list comparing dividend paying stocks to yield farming. So the first one is barriers to entry. And you can see I have them both highlighted green and high on here. So that doesn't mean the barrier to entry is high. It means quite the opposite. High means it's good in that area. Moderate. Low means it's low in that area. So let's elaborate on the first point in barriers to entry. Okay, so for dividend paying stocks, assuming you're a US investor, you can buy them pretty easy, or ETFs that hold them pretty easy, pretty quickly through your brokerage, and then you're immediately on the dividend schedule, right? Not a lot of red tape there. Same thing for yield farming. Doesn't matter who you are or where you're at in the world. You can get started with just a few bucks, just like you can buy a small amount of dividend paying stocks as well in terms of dollar amounts. All you need is access to a smartphone. There are more smartphones than there are people. And there are centralized exchanges or on and off ramps all around the world. You can get some Bitcoin, some ETH, some stable coins, send them to your MetaMask wallet or your crypto wallet and start using them in DeFi to get a yield. Let's move on to the next point. All right, the next point is time frame. Okay, so for dividend paying stocks, we have moderate, and for yield farming, we have high. Let's elaborate. So for dividend paying stocks, like I said, if you're a US investor, you can buy them pretty quickly, and whatever the dividend schedule is, you'll get that depending on when you bought. So that's why I have the time frame as moderate, because they could have just paid the dividend out. It could be annual dividend and it pays out in December and you hopped in January. Now you have to wait a whole nother year. There are some companies that pay quarterly dividends, so it's not like the same schedule every time, but you do have to know the schedule for the dividend payment if you're like looking forward to that. Like some people buy stocks just for the dividend. Some people buy them for both. Some people buy it just for the stocks and it just so happens to pay out a dividend. You really want to take all of those things into account. Now with yield farming, I have it as high because from start to finish, you can be making passive income within a few hours. If you know what you're doing, a couple of minutes, right? And if you want to get access to a flagship yield farming course and community with professional coaches and advanced members who all have each other's best interests, group calls, buy and sell calls, all of the tooling you need to generate reliable and consistent passive income, click the link in the description, book a free strategy session. You'll talk to me or one of our coaches. We'll see if our program is a good fit for you. If not, we're happy to point you in the right direction. I digress. Let's move on to the next point. All right, the next one is passive income amount. Like, how lucrative is it? For stocks, we have it as low. For yield farming, we have it as high. Let's elaborate. So here we are on NerdWallet. And before I even get into this, like you see these percentages here, this is kind of a wild card because it depends on how much money you have. If you're getting 10% a year on a couple $1 million, that adds up really quick. But if you only have a few thousand or a few hundred, then it's kind of like pennies. So you really have to apply this to your situation. But you can see here that the top one is 14.5. Now, when it comes to that yield, there's probably a more high-risk company because dividend paying stock yields aren't historically that crazy, right? So you have these companies here, Franklin, Seven Hills Realty, A&G Mortgage. Seems like most of them are finance companies. And if we go here on Morningstar, you can see the top 10 best dividend paying stocks. You have Verizon, Chevron, Comcast, the Dow, Hershey, just to name a few popular ones, right? And if we look at the yield, Verizon, which is the top one, pretty good company, 6.46%. That's not much higher over inflation, if I'm being honest with you. Chevron, 4.6. Comcast, 3.03. Medtronic, 3.08. So you see these yields. Now, if you go to our Yield Hunter tool, so we have this tool that's for our members, or if you want to just get access to it without, getting a membership, it is $1,000 a year, but it gives you all of the top liquidity pools and all of DeFi in real time, or at least close to it. We have all these chains here, and we have all of these dexes where we pull data from, the most popular ones, right? And you have all these categories here as well, which we just added. You can search by token, you can search by minimum and maximum TVL, and you can see the top pool right now is paying 1,300%, over 1,300%, 600%, 600%, 430%, and Brett ETH, Arbitrum, USDC. So these are like some pretty good tokens. These aren't just like all shitcoin pairs. layerzero, matic, 126%. The top one we saw over there was 14%. We would have to scroll way, way, way down. Like, it's so easy to get over 14% from yield farming. You can have a really, really wide range. Like even ETH USDC, 17.56%, getting paid in ETH and US dollars, right? We're getting around to the top dividend paying stock yields, right? And remember, the more you get paid, the higher risk you take when it comes to those. The cool thing about yield farming is that mainstream banks and financial institutions aren't legally allowed to provide liquidity. So you can get an extremely high yield for really, really low risk, right? This is the golden age of yield farming. It won't always exist in this capacity, and that's why we're trying to spread the word so much. Let's move on to the next point. So the next one is collateral use. Like, can you use it as collateral to borrow money? For dividend paying stocks, we have it as high. For yield farming, we have it as low. Let's elaborate. So for stocks, we have it as high because it's pretty easy to use your stocks as collateral. So just as a bank can allow you to borrow against the equity in your home, your brokerage firm can lend you money against the value of your eligible stocks, bonds, ETFs, and mutual funds in your portfolio. And margin loans typically require a minimum of $2,000 in cash or marginable securities and generally are limited to 50% of the investment's value. Interest rates vary depending on the amount being borrowed, but tend to be lower than the unsecured lending options such as credit cards, right? So not hard to get a loan against your stocks. With yield farming, you can do this. I made a video on a platform called Yielder where you can borrow against your Uniswap V3 positions, but it's not in all dexes yet, right? It's new, it's more risky. Crypto is right now more volatile than stocks, so it's easier to get liquidated. It isn't nearly as much liquidity to do this, which would make it much harder to do if you're a whale or if you have large amounts of money. Like if everyone went to go and try to borrow against their stocks, most people will be able to do it. But if everyone went to go and try to borrow against their yield farming positions, most people will not be able to do it. Hence the rating we gave it. Let's move on to the next point. The next one is cash flow stability, right? How dependable is this passive income, like on a consistent basis, right? In the short term. For stocks, we have it as moderate. For yield farming, we have it as high. Let's elaborate. So while I do think dividend paying stocks will always be around, they can stop paying dividends at any point if they want, which makes the short term a little harder to predict, right? So if it's an annual dividend and you wait until the end of the year and then they decide not to pay out the dividend until the next year, you're not going to be a happy camper, especially if that's the only reason why you bought that stock. With yield farming, you get paid passive income in real time just as long as you're in range. Like anytime there's a swap happening, you're getting paid like in real time. If volume increases, you directly benefit because it results in you filling more orders, which means you're making more passive income. Time in the market versus trying to time the market. We talk about that all the time. And if the pool goes out of range, you can rebalance or find a better pool in less than 2 minutes, and you're right back to generating passive income, maybe even faster if you get access to our Yield Hunter tool, right? Let's go on to the next point. The next thing we have on our list is risk of saturation, right? For stocks, we have it as high, which means it's low risk of saturation. For yield farming, we have it as moderate. Let's elaborate. So I think the more a stock gets bought, the more they're likely to pay a dividend. So I think saturation effects kick in when the economy's down and people are actually selling the stock, so the dividends don't get paid out. But I don't think capital inflows will saturate the yields because, when you go public, like let's say there's 100% of a company and they want to go public, they'll siphon off like 20%, split it up into small shares, and they allow the public to buy a percentage of that company. And this is in an effort to raise capital, right? So if more people are buying the stock, and a lot of companies buy back their own stock and they can use it as collateral to borrow against it, like we kind of just talked about. And at certain times when the stock price is high, companies will sell it. When it's low, they'll buy back their own stock, assuming they believe in their company. So the more people that are buying the stock, the more the price goes up, the more money the companies make because earnings per share is increasing. And that means they're more likely to pay a dividend. So it's different in terms of that. With yield farming, it's a higher risk of saturation because if people or a large whale finds a good pool, they can saturate it immediately because you have something called volume to TVL, right? So let's say you have a TVL, which stands for total value locked. So let's say you have a TVL of 100 million, but you have a daily volume of 200 million. That means you have less mouths and more food. Saturation comes in if people see that pool is just churning out yield. Let's say the TVL goes from 100 million to 300 million and the volume stays the same. Well, now you have more mouths with less food. So more people are hungry, if that makes sense, right? So yield farming is easier to saturate. And once institutions are granted the regulatory green light, the first pool they're going to hop in is probably ETH USDC, ETH Bitcoin, Bitcoin USDC, wrap Bitcoin, right? So the chances of being able to make triple digit yields on ETH USDC pools like blue chip pairs is going to be gone eventually. But there will be other pools that we talk about on this channel all the time that'll still be able to pay out a good yield because they just won't hop into them because they're too risky. The good thing is, if a pool does get saturated, like I said, using our Yield Hunter tool, it'll be pretty easy to find another one to jump into and start getting paid immediately. Let's move on to the next point. All right, the next one is risk of loss, losing your funds. Stocks, we have it as high. Yield farming, we have it as moderate. Let's elaborate. So stocks are held within your brokerage, not self-custody like crypto, so they're pretty safe. You don't hear about stock brokerage hacks and people losing their stock, but there could be stock splits sometimes, but that's different. So it's pretty hard to lose your stuff. Even if you lose your password to your Fidelity account, there's ways to recover your password, right? With yield farming, it's a higher risk of loss. One, because there are smart contract risks. Crypto is newer. Exchanges can get hacked. Your wallet can get hacked. In our course, we do cover the most common ways you can be hacked to minimize them. I've never been hacked, and I've been in crypto since 2017, and none of our members have been hacked either. Okay, so getting back to it. There's another thing called impermanent loss. So like, let's say this is your range on ETH USDC. Your bottom is 2K, your top is 3K. If it goes out of range to the top, yield farming is like a limit order for the underperforming asset. So if this is ETH USDC, 2K, 3K, let's say it goes above 3K, you're going to be in 100% USDC because it's the underperformer. If it goes below 2K, you're going to be in 100% ETH. Now, if you withdraw, and you're like, oh, this shit's not working, it went out of range to the downside, and you take out your ETH, now you sell it, ETH goes back up, you're going to be pissed. And this is why I made videos, and in our course, I cover how to use impermanent loss to your advantage, because it can actually be a good thing. And it doesn't matter as much if you think long term, right? Shit, to be honest, impermanent loss kind of exists in stocks as well, because when you're getting paid a dividend, let's say you're getting paid Apple dividend, Apple drops 20%, it's impermanent loss. If you sell it, Apple goes back up, you're going to be pissed. So it's kind of the same thing, but a little different. Now, let's go to our last point. The last point is long-term stability. How long will it be around long term? So we already talked about the short-term cash flow stability. Now we're talking about the long-term stability. We have moderate on both. Let's elaborate and conclude. So like I said, I don't believe dividend paying stocks are going anywhere anytime soon. You know, it's a way to incentivize investors to hold stocks, just like staking incentivize people to hold a crypto. You just have to be on the lookout for the best dividend paying stocks, and you may have to cycle trade here and there. You know, you have to know how to look at support and resistance and things like that. And you have to know how to spot trends in the economy so you can do your best to predict when you think a company may cut dividends, right? With yield farming, and that's why I say it's moderate, because, you know, I think it'll exist forever, but it'll be certain times where things happen in the economy where you won't get a dividend, and this has happened historically. With yield farming, it's the same kind of thing. It's new. I believe it's here to stay, but I don't know how regulation is going to shake out. Like, are they going to require you to have some license to be a yield farmer in 5 years, or who knows? Like, this is a completely new thing in this industry, right? Market making or yield farming isn't new. It's just new to crypto, and it's never been allowed to be done by the public. So we'll see, you know, how regulation shakes out, and that's why I put it as moderate. I think it'll exist forever, but maybe not in this capacity, okay? So in conclusion, I think crypto is a good asset class to educate yourself on and get into, because the returns are asymmetrical, and that minimal downside, high upside. It's the smallest major asset class in the world, and it's going mainstream. You know, we got the great wealth transfer that says $64 trillion is going to be inherited from millennials, from their parents and grandparents over the next 7 to 8 years. A lot of that money is going to flow into crypto. So dividend paying stocks are a good home to maintain wealth when you have a lot of liquidity. Because if you got millions of dollars, like I said, you're getting 10, 20, 30%. Well, 5, 10, 15, 20, maybe percent. That adds up pretty fast, and it's safe. Right? You don't have to worry about hacks or anything like that. If you do it right, you can be set for life, and so can your next generations. Yeah, and it's good because it's lots of liquidity. You can outperform inflation and not lose capital long term if you do it right. Also, it's cool to use as collateral. You can borrow against your stock positions, and then you can do whatever you want with that money to get even more return. And remember, you don't pay taxes on borrowed funds. So with that, I'd like to conclude this video. I'm doing another one on yield farming versus trading bots. If there's another way of passive income that you guys want me to compare to yield farming, let me know. I'm happy to do a video on it. But if you got value from this one, I ask you to drop a like, drop a comment, subscribe, share with a friend who buys stocks and who buys them to get a yield from the dividends. But other than that, thank you guys so much for watching. I love every single one of you who tuned in, and I will see you in the next one. Take care and trade safe.